All right, welcome to Momentum Mondays. My name is Garrett. This is Matt. We are the co-owners of Momentum Wealth Management. And every Monday we get together and do a podcast. We have a conversation about where the markets were last week and where we think they're headed this week. Today we're going to talk about markets possibly dipping into correction territory, inflation cooling, but not everywhere, and why real wages finally give consumers some breathing room. Plus, we'll talk about stocks and the Federal Reserve moves this week. So let's get into it. I'll throw it to you for the disclosures.
Yes, as always, quick reminder, the views expressed on this podcast are for informational purposes only and should not be considered investment advice. Always consult a financial advisor you trust or visit us at momentumwealth.us before making any investment decisions.
Very good. Round of applause all around. So let's talk about the markets last week. We had some interesting days in the market, namely Monday, which was down considerably, and then Friday, which was positive. And so it still wasn't enough to pull us out of the hole for the week. We've got the S&P down 2.28%, NASDAQ down 2.47%, Dow down 3.01%, Russell down 1.49%. And then we look at gold, up 2.55%, silver up 3.79%, the 10-year price up 0.10%, which means yield down, price up, yield down. We talked about that last week. Bitcoin down 5.86% from that week period of time. I think it's all up today. Last I looked at it this morning, we're filming this the morning of Monday. I forgot to say that. It's Monday, March 17th, 2025. And it's St. Patrick's Day. We talked about the green.
Oh, yes, the green tie. This is our second iteration of beginning the podcast due to technical difficulties. So,
yeah,
but yes,
deja vu.
I do have green.
I did it inadvertently, unintentionally, but here we go. I'll take it. So anyway, we look at what happened in the markets last week. We took the opportunity last week to do a rebalance on our book of business, on our portfolios on Tuesday after Monday's big decline. That's generally something we do here at Momentum Wealth, is take a look at any opportunities, big outside opportunities to buy into positions that are significantly down. And so I think that when our rebalance went on Tuesday, we ended up getting a lot of crypto and some tech stuff. And so I think it worked out well for us. But
a lot of Ethereum.
Yep. That was down pretty big. But that we talked about that too privately. We talked about the fact that Ethereum has these giant swings that it didn't used to have. So it's sort of an interesting kind of development here in the last, would you say, 12 months?
Yeah, it has been interesting. History will show as to why. But alt season hasn't kicked off yet. Really, officially, it has not. So it's good to see the number one alt, which is Ethereum, have some pretty good buying opportunities in it.
How much longer do you think it'll be the number one alt?
The number one alt?
Yeah.
At least another cycle. Probably 4 years from now.
And who is waiting in the wings to take its place?
Yeah, that's as soon as you say it, you'll be proven wrong. There's been a lot of Ethereum killers out there. For those of you that are in the crypto space, you know this to be a fact. Right now, I would say, Solana is probably, but it could be a sleeper, or it could be layer twos on top of Ethereum that don't really, and they're not going to, take market cap significantly away from Ethereum, but they could have more transaction volume. It's hard. A lot of things are built on Ethereum. Ethereum's a solid project. There's criticisms. There's criticisms of everything, but, it could be Solana. It could be a smaller project. I think that we are seeing, with more regulatory clarity coming, I think we are seeing a lot of these projects that the blockchain was really innovative. I could think about Algorand as one that's a Turing Award winner PhD that came up with that designed and produced that protocol. But instead of it being just based on transaction throughput, finality, one's more trustless, one may be more decentralized. Instead of it really just being focused on those aspects of the blockchain, it's more or less which application is best suited for it. Is it real world assets? Is it tokenization? Is it DeFi? Is it
contracts?
Yeah, is it smart contracts? And so I think that a lot of these projects that have been around for a very long time are kind of starting to settle into what they can actually be used for, real world use cases. So I don't know if anything's going to take Ethereum.
It's going to be an interesting thing to have to educate the public on as well, is what kind of use cases they have. Because right now, all you see is in the news. There's no real context behind it. Bitcoin, Ethereum, People
Yeah.
know what they are, but they don't really know what they are.
Yeah, tangible use case, something that affects your life.
Right.
And there are lots of them. I mean, lots of projects out there that are doing great. I think the Bitcoin DeFi space is a sleeper. I think that over time, as more regulation, there's more regulatory clarity, you're going to see the same thing that happened on the Ethereum blockchain as it pertains to decentralized finance start to take place on Bitcoin, and it's going to be an order of magnitude greater than what took place on Ethereum. And that's going to be a lot of value creation. As to when that happens, check in next Monday for our Momentum Mondays podcast. But yes, the indices were down. Now, we mentioned this before the show. You know, how many, or the first iteration of the show, that we had to start over. That how many times do we see, going back to 1928, because there's more up years than down years with the market. That's something you can easily look up. But most people don't realize that the S&P has about a 10% correction every 12 months, once every 12 months. So it's normal to see things like this happen. But unless you do this every day, you're not really analyzing market moves, taking into consideration everything that's happening. It's kind of in a vacuum. Market's down, that's bad. Number went down, bad.
Yeah.
And you always have to have perspective. And, volatility is the price you pay for gains. And we've talked about this before. Pull up over the last 20 years and tell me when was a bad time to buy. If we're just using the S&P, tell me when was a bad time to buy. If you bought at the peak before the 2008 financial crisis, you would have felt completely stupid in doing that. But you're up 4x.
Well, that's the hard thing
right?
about timing the market. It's a very difficult thing to do. And it seems like something that should be a lot easier. Like the news cycles, the market cycles, the talking heads, whatever, tell you doom, doom, doom all the time. Oh, I'll just push the sell button. I'll go to cash and wait for a little while. And it just doesn't end up working like that.
Yeah.
I mean, you have, and it's even hard for people like in our position that we do this every day. It's because you're looking at indicators, you're looking at seasonality, you're looking at sort of things that are not really indicators but are good barometers of success either way, either to the upside or to the downside. We talked last week about the case for the bull scenario versus the bear scenario. We both kind of feel like we're in that bull scenario case where this is a short-term weakness that we see in the market. But yet to be determined. Friday was a positive in a lot of ways. We had Monday, Tuesday, Wednesday, Thursday when we talk about breadth. Something that we love to talk about here, our favorite word. Jared, put that up on the screen, BREADTH.
Good breadth or bad breadth.
Yeah, that's right. So Monday, Tuesday, Wednesday, Thursday was bad breadth. It was more decliners in the market than advancers, meaning more stocks fell than pushed forward. Friday, we saw a reversal of that, and a pretty significant reversal of that in the tech space and some of the high plays there. And so that's positive construction from the market standpoint. The other thing is that, I'm going to go back to Twitter, my favorite tool, X, I guess is what I got to call it now. But there's an analyst over there, Walter Deemer. He's retired now, but he spent years in technical analysis, very well esteemed in this space. And he references the 63-hour moving average, which is kind of a strange average to reference. Normally you see 50-day moving averages or 200-day moving averages, but he looks specifically at the 63-hour moving average because you can kind of see where the market is heading based on how close to certain averages it is. And he was saying that, over the weekend, Friday, the S&P is starting to catch up to its 63-hour moving average, meaning that could signify it's a sort of a change in the shorter term market direction from downtrend to uptrend, because we want to see it closer to those averages. We don't want to see it below the averages. And so we talked about that last week with the S&P. It moved below its 200-day average last week. We don't want to see that happen. So anytime we can get above that or close to it is a positive sign for us and means that there's some real positive things going on in the internals of the market. So I thought that was interesting. If you're on Twitter or X, he's a very good follow. He's retired now, but he's a really smart guy. And then you had things like the February CPI report coming in last week. Inflation was soft. It came back lower than expected. There are still areas of pressure. If we look at this chart that I got from Yahoo Finance, let's pull it up, where inflation is and isn't. 12-month change in the price of this whole laundry list of items. Number one is auto insurance. Obviously, we talk about that a lot with clients. They come to us with auto insurance creeping up and up and up. And, if you haven't shopped for that in a while, I would shop for that. There are still ways to sort of get around that, but it involves changing companies. I wouldn't get too comfortable with one carrier. There's no reason to have emotionality in that. If you've had a carrier for a long time, it's probably time to shop around. Prescription drugs are still up. Rent is still up. And then number fourth is wages, is earnings, rather, is how it's classified here. But that would be what we would classify as real wages. And the difference between real wages and regular wages is what?
That you're making more, your increase in pay is greater than the CPI.
Right.
Yeah, so it's not just a nominal change, it's a real change. You actually have real purchasing power.
Nominal versus real.
Correct. Nominal is just the number amount. Just the number went up. Yeah, number went up or down. But what you want to compare that to is the purchasing power of those dollars.
Right. So if you spend $100 at the grocery store, but now you spend $103, but now you make $102,
you're making less money.
You're making less money. Correct. Because of the cost of everything.
And that's how the insidious nature of inflation and what is generally referred to as an inflation tax, because essentially, inflation comes from the government, and it's essentially a way to spend more money without having to tax the population. So you're going to pay one way or the other. So it's good to see real wages going up. That's great for consumers. It's good to see the rate of change of inflation going down. Everything seems to be moving in that soft landing direction that the Federal Reserve has really been aiming for.
Knock on wood.
Yeah. And one way or another, it looks like it's getting there, and that's good. That's healthy. And yeah, a lot of these things, the shelter cost, they are still elevated, but we are seeing a week. I think we're at the 7th or 8th straight week now of mortgage rates declining. Mm-hmm. So that's going to really yield. The 10-year yield's going. That's really what you want to watch for mortgages. You want to look at that 10-year yield, and so that's. Everything's moving in that direction that the Fed really has been pushing hard on, and rates are biting. So you are seeing people spend less even though their wages are up, which is kind of unusual. You normally don't see that.
Well, I think a lot of the uncertainty.
And so, yes, is borne out in the uncertainty, kind of waiting to see, especially if you're making big purchases. And I believe that 1/3 of consumption spending, 1/3 of the population accounts for more than 2/3 of consumption spending. And so, if you're looking to spend on a big ticket item, you're probably going to wait and say, okay, where am I going to be buying it from? If you're getting a plane or a yacht or a second home, you may be waiting if tariffs affect one of those purchases, such as a plane or a yacht or some things that you want to spend a lot of money on. You may be wanting to wait and see, okay, where am I going to get it from? How's this going to play out? And you could also, a lot of times you have people, if you can park $50 million in, 3-month T-bills and make
almost 5%.
You're not going to spend it right now. You're going to wait until those rates come down a little bit, and then you're going to be okay. Well, now I'll spend some of my interest or spend some of my capital. Well, the other thing
is maybe there's a correlation between, because you also have this survey of the bears, the whatever they call it, the AAII survey of bears. Have you seen that around?
No.
So it's at the highest level since it's at its high levels, and typically that is meaning that more people are bearish on the market than are bullish, but it tends to happen sort of when we've found a bottom, or we will find a bottom soon. But the context around that, I saw an interesting conversation over the weekend with Ryan Dietrich. We posted we posted a tweet from him last week, but he's a Carson Wealth guy. He was on Yahoo Finance talking about the fact that he thinks one of the reasons why that might be so, like the level of bears might be so high right now, is because you had an enormous number of people. I mean, even in my own personal life, I saw this, an enormous amount of people throwing money at Nvidia and the Mag 7 stocks because they were in the news constantly. They're going up. Get on this, jump on this bandwagon, get up, come on, put money in. I would have people, the grandmother would stop me and say, hey, when she found out what I did, I'm thinking about, I've got $300, I'm going to put in Nvidia for my son or for my grandson or whatever it is. And that was common. A lot of people were doing that hadn't historically done that. So now that everything is sort of shaking out, and those names in particular have fallen so hard, is that's causing concern among those people that maybe, may have tendencies to be more, negative about where the market's headed. But could it also have a correlation between spending? if you directly see your investments that you hold in your 401k or otherwise,
it's the wealth effect. Yeah.
Right. Are you going to be more conservative in other areas of your finance? Because you see, and I don't even know that a lot of people have access to those stock tickers in their 401ks, but
most of the time they don't, but it's the whole environment. If you pay attention, if a retail person is just paying attention, most of the time you're paying attention to crafted narratives that don't necessarily give you the whole picture, which is why when you hear people speak negatively about the market, or you have the bears, which is people that expect the market to go down, because they're pointing to specific things that you see in the news cycle, they always seem smarter than they actually are. Because most people don't realize if the perpetual market bears are only right either that one time in that 12-month period.
The perma bears.
The perma bears, yes. Or right once every 4 years. And they sound really smart when they're pointing out all these specific things, but they're wrong 99% of the time per market day. So,
right, but they're the way they frame that, because I know of a lot of YouTube channels and social media posters that fit that classification, that fit that narrative. I'm sure you do too. Mm-hmm. But their whole point is that they've been warning you this whole time. That's what they'll say. So they're not ever saying that they're wrong, and they're not acknowledging that. They're just there to say, I told you so, when it finally happens.
And then it goes back and it's higher than it was when they warned you. And then they're going to start warning you again.
Yeah.
Yeah. So it's just a game that's played. So that's why you need to work with financial professionals that you can trust, that have a well thought out, data driven, methodical approach to how they implement portfolios.
But also who communicate.
Oh, yeah.
Who talk to you.
Yeah.
Right? I mean, who tell you
That's
what's going on and tell you what they're thinking, and are able to answer the questions that you have and address your concerns directly. Yeah. Because nothing else matters.
I'm shocked the more that, we have been managing assets since 2013.
Yep.
So more going on 13 years now, right? Is that my math correct on this? 10, 11, 12.
Yeah.
12 years. Outside of the banks, because before we started our firm, we were working for various different financial institutions. And I'm always surprised at how people are so complacent with never speaking to the person they're paying to manage their money. It's shocking to me. One thing we pride ourselves on is, whether it's an in-person Zoom or a phone call, we want to have conversations with you. We want to get to know you, your situation, what's important to you. That really helps us give great advice in the long run. And most people don't do that. There's just a number, and I don't know what that's a part of. And I don't understand why people are so complacent with just having an 800 number, getting somebody who doesn't know you, doesn't care about your situation, and they're just reading what the algorithm is telling them to put you in.
Well, that's a different kind of scenario. I would say that there's a difference in that, and I think that people get nervous when they look at their account values, and so they tend not to do that. I think that's just kind of human nature across the board. Is you don't want to look at it once a year maybe, and so you're not really that concerned with, starting a conversation about it. But you should at least have a level of awareness of what's going on in the market, because you can use that to counteract the narratives that are going on around you. And we call that tuning out the noise basically here. We talk about that a lot with our client population, is you just have to tune out the noise. You have to know what to listen to. You have to know what to take in and what to let affect you and what not to let affect you. This is not an emotional thing. This is not an emotional business, but a lot of people will use their emotions to dictate what they should do in their 401ks or their IRAs or their brokerage accounts.
Absolute wrong. You do not want to allow emotion to create or change your investment strategy.
Right.
You can't do it. It's not a good thing to do. But that's why, again, having open communication with your client population as an advisor, for any advisors that may be watching, is so important. It's so key, because the more you communicate and are accessible, the clients are going to feel much more able and open to bring concerns that they have and just talk to you about it, because they're not doing this every day. Yeah. I mean, they're not doing this every day, and they want to communicate with someone that can be empathetic and listen, but also at the same time make sure they're on the right course and they're not changing direction because of a bad news cycle or because of a bad market, which is going to happen. You're going to it's cyclical. Nothing goes straight up. But history has shown through patience, resilience, and a good investment strategy, the sky's the limit as far as what your potential is. So it's interesting. Again, once a year, 10% dip happens every single year on average. And so it looks like we may have just went through it. Are we recovering? Are we not? That's yet to be seen. The data is still looking good, kind of underpinning our current bias, which is a bullish bias that we have currently. The data seems to really be underpinning that, anchoring it down more and more as the day goes by. Great to see the wages go up again. That's a very, very important indicator for growth, for long-term growth. So what do we have coming up this week? We have
some big stuff.
Retail sales already actually came out today. It looks like one metric was a little weak, and then the other was as expected. That kind of goes in line with what we saw in February, with the wages beginning to tick up and spending down. So people are definitely,
it's a lot of uncertainty,
trying to hold back on some of the spending. But I have seen, and this is something I pay attention to, that's everyday life, and that's sometimes really good, especially when you're trying to understand the growth potential of risk assets. A lot of times you can look around in the real world, and I'm not talking about television, but you can just look around about what's happening around you and pay attention, and you can start to see shifts and changes in people's behavior when we're on the verge of maybe what part of the S-curve of adoption for different technological changes that we're on. We saw this with Netflix. We saw this with iPhones. We're seeing it now with automated driving, electrification of transportation. You're starting to see those things. But I like to look at the sales and the discounts offered in retail stores and at the grocery stores. And I pay very close attention to that. And I have seen over the past week what I would call significant changes in the clearance, the sales, and the price discounting of groceries and clothing. It's been enough that I've noticed it, and I've been more and more paying attention to it. And the last time that I noticed that to that degree was the beginning of 2017. I specifically remember going to a store in Louisiana, and just the clearances and the price discounts was like shocking. And this is a big box store. They weren't going out of business. They're still around. They were a giant company. And then I noticed that continued for about 2 to 3 more months. And I'm curious if a lot of that has to do with tariff uncertainty. Are they trying to clear out inventory to gather as much cash as they can get in order to kind of, recalibrate,
ride the waves,
where maybe they're not going to get those SKUs, and they're okay with that. So we're going to clear the SKUs out, and we have to figure out, okay, what are we going to put in their place? What's our strategy? What trading partners are we going to buy from? And so it could be that is kind of, we're seeing a repeat of that. It's going to be very interesting though, but I have noticed that. So what I'm seeing in the real world is jiving with the retail sales numbers.
Yeah, it'd be interesting to see more data that we get on that. Tomorrow we have the housing starts and building permits, and Wednesday is the big one. Wednesday is the rate decision.
But
and Jerome Powell's press conference. The Federal Reserve is generally not expected to cut rates this week. I think that's, not saying it couldn't happen. It would be kind of shocking to a lot of people if that did happen. But we're going to be mainly looking for what he says. We're going to be looking for his tone, the kind of keywords that he uses.
Possibly a change of strategy on the balance sheet. We'll see. I'm kind of predicting that a little bit.
QT stopped already?
You said... Right, some fireworks we need are in order if that's the case.
I think so. I think it did.
Mr. Editor, can we put fireworks on the screen? Look, but we have to look at this real quick.
I'm pretty sure I saw that over the weekend. I could be wrong, but we'll figure that out. I'll leave you in charge of that to figure that out. But yeah, I don't think that they're going to move any on that, but I will be interested to see what he says. Thursday we have jobless claims. And then Friday, we've got existing home sales, which will be interesting to see in light of
this. Is so. If we listen, I'm sorry to interrupt you.
Go ahead,
good sir. Pardon me, good sir. So last week we spoke about predicting. You were asking, do I think rate cut? I said I don't think, but I do think potential conversation about the balance sheet, because just mathematically it's going to have to happen soon, because we can't keep robbing liquidity out of the Treasury market and putting all that pressure on retail investors to carry the weight of the Treasury debt. because it's keeping liquidity from other productive means of the economy. And you're also running the risk of, the Fed really doesn't know, and they've openly said this, and it's common sense. They don't really have to say it. It is common sense that, the amount of liquidity that's needed in the system in any certain business cycle that we may be in is an unknown. And they only know if they put too much liquidity or if they break it.
It breaks.
And so, but this weekend, market speculation has picked up that quantitative tightening may conclude in 2025. That's this year for those that are not paying attention. Potentially as early as mid-year, and they're going to be looking on March 19th for Jay Powell to provide more clarity. As of right now, it is still continuing. It is at a reduced pace, but it looks like they're seeing what everybody else is seeing. If you're paying attention to the bond market is screaming bloody murder for that yield. The yield curve wants to steepen, and the only thing keeping that at bay right now is the Fed rates and quantitative tightening.
Meaning longer term rates.
Longer term rates are
higher.
We want a higher
yield because you're being paid for the time
for the duration
in there,
and you're taking the duration risk, which we could explain on a future video because that gets in the weeds. But right now we're kind of like front end.
We're kind of flat.
Yeah,
I mean we're not really flat, but we're kind of flat.
It's somewhat flat.
To your point with the 3-year T-bill or the 3-month T-bills, you can get nearly 5% for those, and then the same for the 30-year or beyond that. And so what you want to see is maybe lower on the shorter term, higher on the longer term because of the risk that you're willing to take that it's going to go up over those longer periods of time.
So that would be good for risk assets. It would be good for economic growth, I think, for us to begin to get some more clarity on that, wind that down, and just kind of hold fast because their balance sheet is still elevated. But again, that may be the appropriate amount of liquidity for this business cycle that we're in. And we've talked before about the potential for them to target maybe a gently higher CPI. I don't know if they will ever come out and admit that. If it did, it would be over a long period of time. But, is the equilibrium maybe a 2.5 this cycle because of onshoring of jobs? Is the equilibrium 2?
Yeah, when are they going to talk about that, I wonder?
I don't think they will for any time this year. I think that it's going to be, let's get the rates down close to neutral, and then they can have that discussion. But inflation expectations still remain very anchored, to use Jay Powell's favorite word when speaking about such expectations, anchored. And so, that the equilibrium rate may be at 2. It could be less. Now you look at the 2010s, they targeted 2, but they didn't get there, which meant you were looking more like a 1.5 was kind of in balance. And so they were more loose probably than they should have been in retrospect, not dangerously so. So they may be okay with CPI printing at 2.3, 2.4, maybe perfectly fine with that for the next couple of years, which again is great for risk assets. If that's the case. But if you're looking to buy a home, if you're looking to refinance your home, you need to wait a little bit longer, but rates are moving. And I predict once that 30-year gets a 5 handle, it's off the races. I've already started seeing in some of my recent travels.
Meaning in the 5s. That's what you mean by 5 handle.
Yeah, in the 5%. In the 5s, without buying down points. So I think that, I've already...
Where are we now?
I think we're at like
something.
6. Let's see.
That'd be interesting to see because
I'm at a 2.9, so I don't really look that much at the mortgage rates.
The conversation has been going on for a very long time about mortgage rates, and we have not seen it come to fruition.
6.61.
Okay, so it'd be interesting to see, but that's a lot better than it has been. As it keeps declining, we'll see what that means in real world language and real world terms. I know we have several clients trying to sell homes right now. Some of them have been successful, some of them have not been successful. So,
and that's really all across a good chunk of the flyover country in the South, mainly. But I've seen a lot of building activity starting to pick up, clearing of property, tearing down of old homes. I don't
think I've ever not seen that though. I mean, they even through all of this, that's been the case, at least where we live.
I've noticed it in areas that you wouldn't, you have some areas that are going to be exempt from people. If there's a large amount of people there, you're going to be able to sell a home.
Right.
Somebody's got to put more money down than they wanted, come off, the cash in order to do it. But some of the areas I've noticed over the past month are just ones that you wouldn't expect. Just different parts that I've traveled through here in the last few weeks. It's
maybe
just been,
maybe investors coming.
That's
back
what it's
to the
looking
table.
like. It's looking like again some significant clearing of land that.
Well, those guys tend to have their ear to the ground. So I mean, when they are in the room, we talked about this before too, but when they are in that sort of environment where they know that they're about to not get paid for their efforts on the ownership side, when they're landlords or whatever, they generally divest those things and go into, treasuries or something that will pay them 4 to 6% on what they got. And then when they see the flip side of that happening, where that's maybe not going to be the case, they got to re-up and get back into that real
capital.
estate. Yeah,
deploy that capital.
So that's interesting. That's an interesting metric to see.
We'll see if it holds up.
But still interesting. Well, if we look at stocks to watch this week based on earnings and based on announcements and things, Nvidia's at the top of our list, hosting their GTC conference this week. We'll be looking to see what they announce in terms of updated AI chips and things like that. We've got Micron with earnings. We'll shed light on some semiconductor demand. Nike's an interesting one. We talked about Nike last week being sort of acting rather
Are they a
like
sponsor
a
of the podcast?
If they want to be, they can. Nike reporting earnings, that will be interesting to watch because specifically Nike went through a CEO change because they had their business model was not going well. They made a change to a guy who has come up through the company. He's been there a long time.
They wanted to go direct to consumer and and kind of abandon their partnerships with retailers, and that didn't seem to work out.
Well,
right?
to a certain extent, yeah. I mean, I think there's a happy medium there, and that's what this guy's got to figure out. So it'd be interesting to see what their earnings are like. FedEx also reporting earnings, logistics data. We see Chinese tech names like Alibaba and JD.com. Looking at that. The other thing that's been in the news is the international equities are kind of starting to outpace domestic equities, and this is... I saw a chart. I should have gotten it, but I saw a chart that is basically like a tiny little blip if you zoom out, over a decade-long period of time. The thing that we're talking about them outpacing is like, this on a giant chart. And so that is very interesting. We don't know if that has legs or if that's going to remain, but it's certainly an interesting conversation to have. This is the importance of diversification across sectors and economies.
And I see here you also have the solar stocks, interesting.
Yes.
Buying activity happening there.
Insider buying activity. But insider buying activity is kind of happening across the board. That's one of the other metrics for the bull case, is that insiders are buying a lot of their own stock up. And so you don't tend to see that if they're concerned the market's going to go down further. You do see that if you think that these people have in their mind that this is a great buying opportunity. And we're seeing a lot of buyers as well. Friday was crazy. Friday was up and down. Friday was like a roller coaster. I mean, you had periods where it was up, and then you had periods where it was down, and then you had periods where it was back up and down, and it finally closed up. It was like a battle watching that in real time. It was crazy. So I think that we are getting to a point. I don't know if we're at the bottom yet. I don't know if we're at the bottom now, this week, next week. I don't know. But we're getting to a point. I think we're going to get some answers soon. I hope.
The bullish side of that is, good 10 to 15% upside from where we're at now. Some analysts, some data gurus would lead you to believe. But this is why you have to have a plan for the long term. It's interesting to look at this. It's interesting to figure out. I think dips like this are a great opportunity to be tactical if you're not already invested, to start deploying some of that capital. It's a great starting point. You can get some pretty easy wins if and when we get back to all-time highs and exceed them. So that's kind of an exciting aspect of it when you see a dip. And if you're not an investor now and you're looking at start to investing in your 401k, into your Roth or traditional, or just looking to open up a brokerage account and begin to grow some money that you can use for something other than retirement, these dips are an exciting time to look at that. But always talk with your financial advisor.
Or just to restructure your portfolio. Maybe pick up some things you didn't have a chance to pick up.
That's right. Do a healthy rebalance. Take some profits from some of your fixed income positions and buy some of your equities that are down. It's a great opportunity to do that. And that's why you have to be working with a financial advisor that understands what's going on, has clarity as to what's going on, and can then help you have a higher degree of confidence.
Well said.
Yeah, it's very well said.
This is a shorter one today. We'll wrap it up here around 35 minutes, but we will be back next week. We'll talk about the Federal Reserve conversation. Maybe we'll post a short video on Wednesday when they make the announcement. Just kind of adding some
yes.
context around that. That might be
Yes.
interesting.
Yeah, we can definitely do that. Well, we can call it the FOMC meeting, and maybe we'll get a lot of clicks. Like put Jay Powell's face on the picture.
I don't know about all that.
FOMC live.
We'll do something.
Yes, but to wrap, you're right. There's a lot of conflicting data. We have inflation easing. Pockets of the economy are still running a little hot as it pertains to inflation. Wages are improving. Volatility remains elevated. But for investors, and if you're looking to be an investor, this is the time for discipline and patience. Don't get ahead of yourself. Don't get upset. Just reach out, talk to an advisor that you trust. Visit us at momentumwealth.us and focus on good quality relationships with your financial institutions, your financial advisors. Understand the importance of diversification. Keep an eye on the data. Thanks for tuning in.
Man, that's a good wrap up.
Peace.
We'll end it here. Goodbye.